Welcome back, YouTube. This is your designated Inquirer. My name's Axel, and this is another market day. Today is 8/3/2020. We're a couple days post the expiration of the unemployment payments, the moratorium on rental evictions, and yeah, things aren't looking good. There's still no decision, there's no agreement on what kind of package to put together, and while that's happening, there's still people that are suffering. There are now probably people that are being kicked out of their homes as we speak. None of that is any good, and yet somehow the market is acting as if it's already a foregone conclusion that we're going to get this package, and what it'll kind of look like. The assumption being that it's between $1 and $3 trillion, which is somewhat of a, statistically high chance of happening, but still no guarantee that it will, as there's still some debate as to whether a skinny bill will be passed in terms of just being able to help people with the rent eviction moratorium, and or still not pass any stimulus whatsoever. If that's the case, the moratoriums aren't necessarily going to be the rent evictions isn't going to be the only thing that's going to be wrong with the United States. It's going to be the ton of jobs that are just going to evaporate from the planet, all in succession, because the U.S. is a very large piece of the world economy. So that's not any good. Apple, or more or less the Nasdaq today, took a look at what's happening in the last few days, managed to reach the all-time highs, and actually managed to go above it, where the last all-time high was 1158.5, and the new current high is 11073. It wasn't a ton higher, like between, assuming this line and the last, let's make a quick line. It's 0.15% higher than its previous all-time high. As far as I'm concerned, it basically bounced off of a resistance. But apart from that, well, what does that mean, right? If it did bounce off of a resistance here, and it did not clear, it did not meaningfully go above the previous highs, then that means what exactly? It means that most likely the market will be going down. Apart from that, I've been seeing more stories, right, as to how there might be another market crash. Apart from this, why would they come to this sort of conclusion? Like, well, if we draw a line connecting more or less the bottoms of what has been the bottom of the market at some point in time, if you go ahead and you extend it to the right, it seems as though we may have either crashed through to some extent and somewhat recovered, so it may just be a prolonged and or a less accelerated bull market, in which case you're still having a problem where you're kind of pieing. Pieing means that at some point the curve looked like this, and then it looked like this, and now it looks like that. But which one is the actual line and the trend line in which we should be following? Well, there really isn't one. There's more of a curve. It's kind of flattening out, and you get to a point where it stops flattening out and you just fall, because you're trying to find out, well, where are assets rightfully priced? Well, we don't know exactly yet. Not yet, anyway. Because, well, we haven't gone through the correction phase, right? Consolidation of demand, right? We haven't aggregated the opinions of thousands of investors to be like, okay, if earnings drop, what sort of price multiple are we willing to pay for these companies with their ability to stay alive during the crisis and go further higher later on, like a couple years, 5 years from now. How long? What am I willing to pay to be able to hold on to this company? So that's the question, right? So right now, it may be that we triple topped, which is not a good sign in either case. It's not a good sign. We're not that far away from it. We didn't drop just, precipitously from that level. So it's not a giant glaring, like, oh my God, we're gonna crash. Like, we haven't gotten there yet. But we're not really going anywhere. It's kind of hugging the top. For it being a single day, this is relatively very little movement for a single day. We haven't really had a really flat day like this, where nearly nothing happened in the last time that happened was around here, maybe. And maybe you could say around here. Like, it could be. So this is what's called compression, right? And compression means that there is buying and selling to kind of prepare for a either sharp move to the upside and or to the downside. I still maintain that there's a fair amount of pressure to point to the downside, but we've still been getting somewhat delayed information in terms of like to tell what the economy has been doing before June. So for the month of June, which was still somewhat rosy colored, and that we only saw a dip in economic indicators at the end of June and into July. We're now in August, so we're a full month where a lot of people will have to see that data, but like not for a month or a couple months from now, and where they'll start to realize, oh, the economy's not doing so great, it's not doing too hot because of all the shutdowns that happened, etc., and all this other stuff. So it's not going to be until it's too late to where like investors and economists and other stuff are going to be able to price in accurately deleterious data, meaning information that points to a weakening of economic indicators, and that's not good. Apart from that, I have so the increase in propensity for articles to be written about a crash happening is part of what a lot of people would call a self-fulfilling prophecy. Now, to a lot of people that happen to follow the market for a very long time know this very well. Whenever people start talking about a recession, etc., it gets to a point where it's almost, you're kind of almost forced to go through a motion where like a lot of assets have to be stripped down and readjusted, that there has to be some sort of correction to an overzealous population of traders, etc., investors that think that the world is only going to go up, that there is no downside to trading, that there is no risk, where we know that's technically impossible. So to a certain extent, the market will have to somehow price in the risk that has existed, that people are living through. At some point, they're going to have to price that in accurately, but they're not going to be able to do that until there's a significant drops to let them know that, hey, maybe not everything is all right. But until that happens, it's going to be hard to know what that bottom looks like. It's going to be hard to know how much of a loss was made and where the foundation of economic activity is actually at, right? So that's what a correction serves. That's the function of a correction, is to actually let you know where the foundation is above the froth that there exists a baseline of economic activity. To a certain extent, this was kind of installed, and that's why it only went down 32%, versus if we go back 3 years, not 3 years, we want to go back 20 years. From the last downturn, which was in 2008, right here. If we take a look at this area right here, we had a drop. We had a drop of 54%. That's how far down the market dropped. 54%. That was back then when we had dropped a total of 9% for the economy, for 3%. Let's take a look at what was the worst hit. If we take a look at what the economy was, we're going to take a look at what the economy did. 2009 recession. Recession GDP. Recession GDP. Okay, it dropped 5%. 5% drop, and that caused a 54% drop in the stock price. Right now we dropped 32% in one quarter, and for the whole year we're expecting a drop of about 9% for the whole year. That is ridiculous, and that we're still up here is bonkers, right? That's the premise. That's why I think that there has to be some sort of correction. That this correction that we saw here was not really a correction. This was a visit. This was a visit and a delusion to what we're probably going to be expecting. And just to put into context, what would a 54% drop look like? Which I'm still expecting something that would be worse than that. A 54% drop would be here. 5,000. 5,080. A level we haven't seen since 2016, right? That's what we're expecting. That's what I'm expecting. That's where I would say, like, okay, we found the bottom. We found where this thing messed up. We found out that where the basis of economic activity is, and where we can actually start building onto that foundation instead of building on top of froth. So anyway, what I wanted to discuss was why there's a propensity for why there is a propensity for prophecies to be self-fulfilling, especially if they happen to be negative. And that's because, let's change the song here, because this is a little weird. Alright, I like this one. This one's good. This one's chill. I like this song. Alright. So, self-fulfilling prophecies. If they're negative, why do they more than not seem to happen, especially when we're talking about recessions? Because fear is predictable. Instilling fear in people is predictable in terms of its effects and how they tend to act. Right now, in Congress not passing the stimulus is actually overall increasing the level of fear in the consumer. There's going to be a lot more people that are going to take this next stimulus check and not actually spend it because they are afraid of what Congress is doing right now, which is letting them fall. There's a lot of people that are going to be like kicked out of their apartments and stuff like that. They're going to be receiving a check, but are they going to go ahead and spend it? Probably not. Probably not. Not how they went and they spent their last check, because now they have no protection. Now they feel like they have no protection because the Congress can go ahead and do it again. They can go ahead and leave them out in the cold again, right? So now there's going to be a little bit of stickiness to risk averse behavior. Now, how easily it was for people to spend that $1,200 before is not going to happen again. So there's probably more damage right now being done because of the lack of action from Congress. In McConnell not taking action earlier and being able to put forth a bill that they could actually, argue against each other and present something in a timely manner to pass something good, he's actually done more damage to endanger the entire economy. So this brinksmanship only serves to further deteriorate the foundation of the economic activity, which is terrible. But that's why self-fulfilling prophecies tend to happen, because negative behavior, or a behavior that anticipates negative outcomes, tends to be more sticky than behavior that tends to anticipate positive outcomes. There is a overall, if you're taking a look at what is called the cone of probability of future events happening, whether or not the distribution is to the upside and or to the downside, your perception of what can happen will be somewhat skewed to the downside if fear increases in your surroundings. So if Congress is not going to pass anything, hasn't passed anything, that's going to skew what you see as a cone of probability of situations that can happen to the downside. And that's happening en masse right now. So apart from people not feeling safe because of the virus or whatnot, whether or not they take it seriously or not, economically speaking, there's now going to have a different incentive not to spend because of how Congress is acting at the moment, and their decisions not to pass something, in a timely manner. So, yeah, I don't think that necessarily anything has changed to the positive. Anything, I feel like there's a further deterioration of factors that is probably going to add to the probability of there being a downturn at the moment, as the way I see it. Even though that there was last week positive earnings that were displayed by the tech sector and whatnot, while great, that's good, it still doesn't show how people are going to be dealing with this information here in the next 6 months, which I don't think is going to be any good, because in October we still have waves of unemployment that's going to happen, and when you add a dollar to the economy, there's a multiplier effect that happens from that. There is also the same effect, but to the negative side. If you take away a dollar from the economy, that's also taking away the multiplied dollars from the economy that could have gone into other people's pockets. Same thing is happening right now. So yeah, as there are going to be more layoffs, there's going to be more dollars not being spent. As there's less stimulus being given, there's going to be less dollars being spent. But also, it's not just the straight dollars that weren't spent, it's also the future dollars that were not spent either. So the probability of growth declines dramatically when there are dollars being taken out of the economy. And if you're also including the increased fear in the consumer, it's a recipe for disaster. So there's still not enough factors adding to consumer confidence, I think, to overcompensate the probability of there being a second dip to the economy right now. I still want to see what consumer credit looks like here in the next few days. I expect it to come out whether around the 5th or this week. Probably by the end of this week, we'll see those numbers, and when it happens, I'll let you guys know what it looks like as to what happened in June as far as credit is concerned. Because right now we only have May's numbers. So, yeah, that's all for today. If you guys find any value in what I say or how I say, etc., whatnot, please give me a like, subscribe, etc. Let me know what you guys think. If you guys have any questions, if there's a topic that you guys would like me to cover, as to like something that may or may not be affecting the current stocks, the economy, things like that. Maybe I have an opinion about it, etc. So, yeah, let me know, and I will catch you guys later. Till then, take care, stay safe.